Welcome to the Money Talks year-end special. I'm going to be joined by Michael and Ozzie and Victor to get their take on the biggest stories of the year. Also, James Thorne is going to be with me to drop by with his crystal ball. And I got to say, that crystal ball has served him very well during the pandemic, but I got to know what's coming next. And speaking of what's coming next, let me start with what I think is arguably the most important financial story that impacts all of us. But come on, it's also one of the easiest forecasts for the coming year. And that is, we're going to be paying higher taxes for a lot of things, especially if you compare those prices with pre-pandemic period before restrictions and lockdowns created shortages and supply chain issues once demand started to pick up. But that's not the whole story. No, governments would like you to think it's the whole story, but it's not. Governments also created massive amounts of money with the help of the central banks. In the US, for example, the Federal Reserve created money supply, increased it by an astounding 40% in just 2 years. I mean, that's a heck of a lot of money chasing goods and services. Now, we can talk definitions of inflation, whether it's transitory or not, but in the end, the only thing that matters is you're going to be paying more for a wide variety of goods and services. But rising prices for essentials like food or shelter, housing, are going to continue to be a huge problem for many, especially low-income families and individuals. And I'm not just talking about a few dollars. No, StatsCan says inflation in November, for example, came in at 4.7%, which basically says on average, what you paid $100 for last year, you're now going to pay $104.70. But you know what? As I suspect every one of us who's actually filled up our car or grocery shopped or done a home reno knows our cost of living is going up a lot faster than 4.7%. You know, heck, $10 worth of bacon you bought last year now costs you over $12. That $50 gas fill-up last Christmas now costs you over $71. And the cost of materials and labor for maintenance on your home, come on, up way over 50%. And the list goes on. I mean, $10 worth of apples last year cost you over $12 now. But the thing is, there's more to come. The Dalhousie Agri-Food Analytics Lab predicts that the average family of four is going to pay on top of this year's increases. No, they're going to pay an extra $966 in 2022. Just for groceries, an extra $966. But think about the impact of inflation. On the average Canadian, they earn $1,130 a week. So I'm going to give you a lot of numbers, but just think of the bottom line here. If inflation's 4.7% over a year, well, the purchases you made last year now cost you $53 more. That's over $2,700 per year. And I don't want to confuse you, but come on, that $2,700 you have to come up with is after you've paid income tax. Now, obviously, it depends what province you live in, but on average, you need to earn something like $3,500 in extra income. Then you pay the federal and provincial tax of about $700. Then you end up with the $2,700 for the same goods you bought a year ago. Nothing extra. Look, again, I'm sorry for all the numbers. I don't want to make this too complicated. The point is that inflation is bad news for your cost of living. And so much of it has to do with government policy. I mean, speaking of which, wait till you hear my shocking stat. Something you haven't heard a lot about, if any, but it means that every worker, including you, is going to pay more starting in just a few days. Now, a connection between government policy and prices is one that politicians do not want you to make. And it's kind of interesting how many Canadians seem willing to comply. Nonetheless, government policy plays a huge role in these price increases. Here's an easy one. Property tax. Calgary homeowners are looking at an increase of just under 4%, but they should feel lucky because in Vancouver, homeowners are going to pay an extra 6.3%. And as much as possible, by the way, those increases will get passed along to renters. I mean, I know it's just so easy to say the impact of government or to see the impact of government on gas prices, given that as much as a third of the price at the pump is due to some form of taxation. And come on, we even pay GST on the taxes levied, including the carbon tax. That adds billions of dollars to government coffers, while at the same time, it increases the cost of delivery of goods. Why? Because their fuel costs went up. That gets passed along in the form of higher prices to consumers. Which brings me to what is arguably the biggest financial and economic story of the year. Well, it certainly was if you live in the UK, EU, or China. But it's big for us because it could be a foreshadowing of what's going to happen here. I'm talking about the massive increase in energy prices, natural gas, coal, diesel, up hundreds of %. Devastating for so many individuals and families who simply cannot afford the increase in electricity and home heating costs, along with some jobs, by the way, who were put on hold because manufacturing facilities were forced to close. Now, I know we've talked a lot about the impact of pushing to eliminate investment in fossil fuels while demand is rising, but before alternative energy grids are ready to handle the load. I mean, we've talked about the folly of having no backup power source when the wind doesn't blow and the sun doesn't shine. Germany's experiencing that right now. The result, though, is higher prices for consumers, sharply higher in a lot of cases, as a result, direct result of government policy. Now, this week, by the way, and arguably the most important story I saw, well, it was actually last week. It was a Saudi oil minister said that global oil production could drop 30% by the end of the decade because of falling investment. Against that, put that against the significant increase in demand that's coming as emerging markets consumption grows. Unfortunately, I'm going to have a lot of other time to talk about this in the new year. But let me finish by saying, it's easy to say we'll all be paying more. Maybe you can afford it. But what's clear, it's going to be very difficult for a huge number of Canadians. Forgive my glibness, but it's just another reminder of what J.P. Morgan observed, and that is, go ahead, ignore economics and finance. Trouble is, they won't ignore you. As I've said, I've got another increase that impacts every worker in my shocking stat. You can't afford to miss it. But let's get on with the quotes of the week. You're going to love it. The goofy of the year, the last one, and you're going to hear what Michael, Victor, Ozzie, and Jim Thorne think are the most important takeaways of 2021 with an eye to what's coming next. You're listening to the Year in Review Money Talk Show. Have a look forward to. Still to come, I've got James Thorne, I've got Victor Adair, I've got Ozzie Jurek, but right now I'm going to bring in Mike Levy. Mike, I was just thinking maybe we should have all chatted first because I don't know what you're going to say to this question, but I want to know when you look back on the year, what's the main one or two, or you could have three items, whatever, that's jumped out at you that you think has been noteworthy?
Well, we've been doing this now for 6 months, Mike, this one word that has been really at the heart of the crux of what you and I have been talking about. And that word is transitory. Transitory inflation. Inflation is not going to go up. It's going to be permanently go up. It's going to be transitory.
Yeah, and of course, that's what I was alluding to in my editorial, that the short term keeps on getting longer term. It was always depending on what your definition was. I mean, the Roman Empire after 500 years was transitory, so they were always going to be right. But it is important that I think the inflation story is a huge one for people's personal pocketbooks. And, at the same time, you had finally Chairman Powell in December sort of walk back the transitory. He says, I'm not going to use that anymore, which was at least some level of acknowledgement that it wasn't just short term. After all, we'd already been about 8 months of it.
And it wasn't even just Chairman Powell. The Bank of Canada said transitory. Federal Reserve, as you just said transitory. The European Central Bank said transitory. Most, not all, economists, Canadian bank economists, said transitory. Then on June 12th, Saturday, June 12th, in our discussion that morning, we talked about the fact that the annual inflation rate in April climbed to nearly a decade high. Pace of inflation rose to 3.4%. What are we now? 6.8%. But the fact is they were still talking transitory. And I said, no. I said, we are going to see inflation build. We're going to see it build steadily, and we're going to see the central banks having to come in. We even saw the Canadian dollar responding to higher inflation then, Mike, combined with higher oil prices. The dollar topped 83 cents for the first time in more than 6 years. And that was back then. And my view, then we will see inflation bypass neutral rates. And now that we're year end, that's exactly what's going on. The Fed, the Bank of Canada, talking significant interest rate hikes, not significant in the amount of the hike, but significant in the repetition of the hikes. We see the Bank of Canada 2, possibly 3 times. And Chairman Powell just recently said they're looking for 3 hikes. So, and by the way, inflation now, 6.8% in the U.S., 4.7% in Canada. So certainly we took a look at that, and we were steadfast in the fact that this was going to happen.
Well, and again, they didn't define transitory as one thing, but the second side you're saying, it's the inflation debate, which obviously has a direct impact. I'm going to pay more for food this coming year. I'm going to pay more for, I've been paying more for energy, but boy, you look at what happened in Europe, it could get worse than that over the next few years. Things that are so direct to me, property taxes going up, et cetera. So it's where I live. But the second side is what you're alluding to, is that the inflationary pressures put upward pressure on interest rates. And when we know that a quarter of the mortgages in Canada are variable rate, as an example, we're a debt-laden country, debt-laden world. So that interest rate side is what makes the inflation story even more pertinent.
It does, Mike. And when you take a look, as you say, about food prices, energy prices, the price of building a home, the price of goods that are held up in the supply chain, and retailers having to raise prices just because of the cost of bringing goods in, the shortage of inventory going into Christmas. A lot of our listeners will attest to the fact that there are shortages. And the fact is, we took a look at that. We thought what was coming down the pike, and it did. And we're all now living that inflation, and everybody is feeling it. There's nobody that's numb to this.
Let's take a quick jump into 2022. We come into the new year. Number one, I think you've just alluded to this. So you're expecting these higher prices to persist, even gain some.
I am, Mike, but I've got to tell you is that I now am going to stick my neck out as I did on June 12th. I don't think this is going to be sustained or maintained. Sure, we're going to see our interest rate hikes. Sure, we're going to see some inflation, but we're not going to see anywhere near the level of inflation that we saw during this year. Our inflation rates may fall to a third of that. We may get inflation at 1.5% and 2% as we get into mid-year. And I think that there's one factor. You and I talked about that last time we spoke, and that's the new Omicron variant, which could put a kibosh on business, on the economy. And if you want just a little taste of that, look what's happening to the travel and leisure business right now. Look what's happening to the airlines right now. And we have this variant, which is so significantly being passed in every country. The infections are just mounting astronomically, and that could have an impact on business and the economy and inflation once again. And I think by mid-year, the banks are going to pull their horns in, and we're going to see a completely different story. That's my look at 2022.
One thing to keep in mind for everybody is that, of course, the new inflation rates are going to be compared to this year. So we'll have already had, say, a 6 or a 10 or 12% increase, and it will be compared to that, as opposed to looking back 2 years. We're never going back to those pre-pandemic prices unless we have a depression. Mike, let's hope we don't do that, but we'll be here to chronicle it all. In the meantime, have a wonderful New Year's. Take pictures. We'll put them up. We'll blackmail you. Thanks for taking the time.
Don't blackmail me again this year, Mike. Happy New Year to you and all our listeners.
Time now for the quotes of the year. More accurately, 5 quotes of the year, because I've got 5 categories. Let's start with the political quote of the year. In announcing she was not going to seek re-election, former Attorney General Jody Wilson-Raybould stated, "From my seat over the last 6 years, I've noticed a change in Parliament, a regression. It has become more and more toxic and ineffective, while simultaneously marginalizing individuals from certain backgrounds. Federal politics is, in my view, increasingly a disgraceful triumph of harmful partisanship over substantive action." End of quote. Well, certainly there's no shortage of examples of lack of substantive action. Come on, the failure of Health Canada even have a pandemic plan, their job, led to numerous other missteps. How about the lack of clean drinking water in some First Nations communities? That continues. Commissioner of the Environment found Canada was dead last when it came to carbon emission reductions compared to all other G7 nations. Final example, lack of substantive action, you bet. The OECD forecasts that Canada will have the worst economic growth in the next 10 years among advanced economies. Next up, the tragic debacle of the withdrawal from Afghanistan. This quote is from former CIA ops officer Brian Dean Wright. He's talking about the fallout. In quotes, Afghanistan has shown the world, enemies and allies alike, that our military and intel assets are largely irrelevant because we can't deploy them successfully. The blame lays at the feet of multiple presidents, the generals, the spies, the Congress. America's elites are trash. Here's one for the mainstream media. Well-known and well-respected columnist Barry Weiss, in resigning from the New York Times, said in quotes, "A new consensus has emerged in the press, but perhaps especially at this paper, that truth isn't a process of collective discovery, but an orthodoxy already known to an enlightened few whose job it is to inform everyone else." Next up, well, I could have chosen one of many, many quotes on COVID, but I chose this one because it's directed at all of us personally. By V.K. Prasad. He's a hematologist, oncologist, health researcher. Also, he's an associate professor at the University of California, along with medical researcher Carrington Powell. They're critics of what is called the noble lie. In other words, health officials sort of trying to manage us, not quite telling us the truth. Anthony Fauci comes to mind for this for me. In quotes, "Do we want public health officers to report facts and uncertainties transparently? Or do we want them to shape information via nudges to influence the public to take specific actions? The former fosters an open and honest dialogue with the public to facilitate democratic policymaking. The second subverts the very idea of a democracy and implies that those who set the rules or shape the media narrative are justified in depriving the public of information that they may consider or value differently." End of quote. And finally, on climate change, this one caused quite a stir. By Michael Schellenberger, Time Magazine Hero of the Environment, Green Book Award winner, founder and president of Environmental Progress. In quotes, "On behalf of environmentalists everywhere, I would like to formally apologize for the climate scare we created over the last 30 years. Climate change is happening. It's just not the end of the world. It's not even our most serious environmental problem." But, just as importantly as this admission by him, in quotes, "I remain quiet about the climate disinformation campaign because I was afraid of losing friends and funding. The few times I summoned the courage to defend climate science from those who misrepresent it, I suffered harsh consequences. And so I mostly stood by and did next to nothing as my fellow environmentalists terrified the public." End of quote. I kind of like that. I mostly stood by and did next to nothing. I wonder how many of us would look in the mirror and say the same thing when it comes to just a huge variety of issues. One for me that jumps out is the increasing censorship. I was thinking about doing a year in review show, having a bit of a look forward, and I thought, who would I love to have here? And literally the first name on my list was James Thorne. He's the chief market strategist for Wellington Altus. And first of all, Jim, thank you for finding time. I know it's busy. We look back on the year. Christmas has come and gone. People are getting ready for New Year's Eve, that kind of stuff. So I appreciate you finding time. Let me just start with just firing, get right to it. When you look back on 2021, what do you think the main takeaways are for investors?
I think that the main takeaways are the fact that, it's going to take us a while to get out of this COVID-19 pandemic. I think that's the first. Two, we really have to get a handle on what central bankers are going to do moving forward. Do they have the markets back? Are they going to are we going to experience a major policy mistake on their behalf? I think people forget that they raised rates going into the teeth of the global financial crisis. And until we get clarity on this pandemic, I think it's folly for them to take liquidity out of the system, one, but two, to even think about contracting the balance sheet and raising interest rates. To me, we look at 2022 as the year of the Fed. So as far as we're concerned, 2021 played out the way we thought. In 20, we said, the S&P would close somewhere between 4,500 and 4,600. We're there. And now what we're trying to do is get our handle on, what would be reasonable to assume what central bankers are going to do in 2022.
Isn't a ton of that it's going to do? We've got these new restrictions coming in. There's worries about more restrictions coming. And one of the things that the Federal Reserve has made very clear about their interest rate policy is they're going to be data driven and they want to see the data. To me, that would indicate maybe people who are worried and think they're going to go kind of interest rate crazy here, maybe a little bit ahead of the curve here. There's bound to be disruptions once you start getting the travel restrictions, which we've already seen. There's bound to be a disruption to the economy. So I kind of think that means the Fed is going to be more hesitant to raise rates.
You're right. And I'm going to put my economist hat on here for 30 seconds. We go back to Bernanke in 2002 when he talks about deflation. Look, let's be blunt. The risk isn't inflation. Yes, we have a supply shock that has increased prices, no doubt. But the point that I would like to make is that demographics, technology, debt to GDP, and globalization are strong secular deflationary forces that have been strengthened, not weakened. So will the central bankers grasp defeat from the jaws of victory? And what do I mean by that? 2002, Bernanke was talking about the fact that the way we get out of this deflationary structural situation is to make the street feel as though the Fed is behind the curve and yet have long-term inflationary expectations anchored. One, they've achieved that. Two, 2005, Mervyn King did a really, really important speech when he was the head of the Bank of England, and he called it the Maradona effect. And what he was talking about was in 86 at the World Cup, Maradona's second goal against England. And for those of you who don't know how important this was, remember, we're just coming out of the Falkland Islands. This was the number one game at the World Cup. Maradona, after he scored the hand of God goal for the first goal against England, he ran straight from midfield to the net and everybody parted ways. And why is this important? Because Mervyn King says, in situations where you cannot raise interest rates, but if you can control expectations by communication, that is the optimal policy, which is exactly what Bernanke said in 2002. So what I would suggest to you is they can't raise rates. They won't raise rates. And they can't contract the balance sheet. This is exactly like post-1945, where we have to have a period of financial repression, where inflation is above interest rates. So for us, it's, do they do a light touch and don't raise interest rates and contract the balance sheet? Or do they try to raise interest rates a couple of times? And if they do, then we get 2018 in the back half of the year where we have a significant correction. So that's kind of the framework that we're looking at in terms of 2022.
I love the way you're putting that, though, because that would have been my next question, is that, a little bit outside of it, but is how can they raise rates? You've got a world awash in debt. You've got a U.S. government awash in debt. You've got the U.S. consumer awash in debt. And raising rates, I'm not sure if that's a viable option. So I've seen the same thing. What they do is they like to talk about it. They like to talk that we're on top of. First, it was inflation's not here to stay anyway, so I don't have to move rates to solve that problem. And then they may be right. If Omicron, for example, very simply, is a big problem, and supply chains sort of clear up, a lot of the inflationary pressures may go also. But I'm so interested to hear you say that, because that's my big question is, we can debate interest rates going up or not, and it's very important, I know, but wait a second, they really can't do it. And let me throw one more for you, Jim, is they benefit from inflation. they've got a massive debt problem. The government's revenues will go up. Business will, at least in the early stages, or let's say it was inflation, it wasn't going to dissipate, but still, you're going to see a huge rise in business income and earnings and stuff like that, means more tax revenue. So I'm not so doom and gloom over the inflation thing, other than if I'm an individual and I hate to pay more for food, gas, and shelter.
Right. So you're absolutely. So let's go a little bit even more nuanced, right? What people use today for inflationary expectations are what is called the break-evens, right? And the 5-year break-evens and the 10-year break-evens. Now, if I said to you guys, look, quantitative easing has distorted interest rates. It has really distorted interest rates in the inflation-protected bond market, or what they call TIPS market, where the Fed is somewhere between 30 to 40% of the market. When they accelerate the tapering, what they're also doing is they're accelerating the distortionary effect they have in these little small markets. Why is that important? Because when they reduce, taper, they are also reducing inflationary expectations rapidly. So if you look at the 5-year break-evens and the 10-year break-evens, they are coming down fast. And if they keep going the way they do, in the spring, we're going to pivot. All of those people that are banging pots and pans on mainstream media about inflation, they're going to be talking about deflation again. And so for when we talk to our clients, we have to be prepared for a policy mistake, for sure. But we think that you're absolutely right. They can't raise interest rates. Think about this. We have a slowing economy, right? We have fiscal drag because Build Back Better has been put on the back burners. And yet all the pundits on mainstream media are telling you to buy cyclicals. What? Buy stocks that's growth is solely dependent on GDP growth, and yet we have rapidly declining GDP growth and deflation in 2022. Are you kidding me? It's bizarre, but yet that provides us the opportunity to create value for our clients, to look at the world a little bit differently. And you're absolutely right. They can't raise rates. They can't raise. This is 1945 to 1960. Last point I want to make about this is that deflation is demographics. What happened after World War II is we had a 40%, yes, that's 40% increase in population growth in North America. That hit the mainstream in the 1970s. The 1970s was a massive demand side demographic shock. Yes, Nixon went off the gold standard. We get it. But at the same point in time, the smart money in the city of London and in New York City know this. And when you look at it and you take that deflationary bubble, which is the baby boomers, and you move it out 20 years, it's extremely deflationary. So, that's what we get paid for, is to help our clients navigate the noise that is created by other areas in the market that just don't do the basic blocking and tackling and research.
And speaking of noise, I just want to shift a bit to politics, because in the end, everything comes back to that when you talk about policy, or so much of it does. The midterm elections. Just a quick take, as you just mentioned, coming into Christmas, it looks like very clearly that the Build Back Better $2 trillion infrastructure, whatever they were calling it, they make up a name they think will sell. But Joe Manchin says, I'm not voting for it, so it's not going through. So that had an impact on the market quickly. But we've got the midterms. It just reminded me of their importance. Could we shift? Or do you factor in that? You say, well, we'll just handle that when we get there.
Yes, it's important. So let's just look at the history. First off, if you look at the 4-year cycle and you look at the midterm election year, you want to sell the market in the first 2 months of the year. You want to come back in the late September, early October, when all the political risk has been eliminated. And then from there, in the 4-year cycle, the next 3 quarters are the strongest 3 quarters for returns in the 4-year cycle. So that's why we say we're very, we think 5,300 on the S&P 500 next year is doable. That's our target number, but we think it's back end loaded. Look, Biden's agenda is dead in water. He is a lame duck president moving forward. And so what I think is very interesting and what we keep pounding on, and one of the key tenets of our research, is the fact that the rise of populism is even more and more intensified. And Michael, you and I have talked about this ad nauseum, right? So Trump was in Texas last week. This is going to be very, very interesting to see how this plays out. So I'm of the view that, the Republicans are going to get the House and the Senate after the midterm elections. But that doesn't mean MAGA, right? That doesn't mean a Trump version. It means that you've got the Republicans, which is a divided party, just like the Democrats, moving forward. This is a very, very unique time in history where we're handing off the political power from the baby boomers to the millennials. And we should expect a period of extreme structural change. And so we would expect that 23 would be a very good, very strong year for stock prices. But yet 24 is going to be very messy because we're going to be coming into the election. And I'll put this out to you. And I talked about this last time we met in person, was if Donald Trump runs, who are the Democrats going to put in? And I just don't think they have anybody other than Hillary Clinton to run against them. I really don't. And I know that might sound provocative, but I really think Donald Trump's going to try to run again in 24, and the Democrats need to get ready for that.
As I say, the rise in populism, we talk about it because it's the driving force of so many aspects of our society and life. And I'm still there saying we're not near end of that trend. And they're doing nothing to anticipate that trend, by the way, in my opinion.
It's we're just getting started. And previously in history, the way we end this off is a civil war, a revolution, or a world war. I don't think that's going to happen, but yeah, we are in a period of time of extreme structural and social change.
And that's what we'll get a chance, by the way, to talk about at the World Outlook Conference. And I'm looking forward to that because that's the framework. That explains, or, that's a great context of which to understand what's going on socially. You look at the protesting that gets underreported, if reported at all, in Europe. I mean, it's dramatic. And I just look at that going, oh, yeah, well, that's part of that systemic change going on, and we'll be fascinated. So let me finish with this, Jim. I've taken too much of your time, but just very quickly. So where are you directing specifically investors to survive this next year and thrive in the environment?
I think on it. So we would expect the first half of next year to be messy. And as we realize that the Fed is not going to raise rates and contract the balance sheet, we think that those areas that have structural secular tailwinds in digitization and innovation are the places to be. So we still, as you said before, when I first met you, every company is a digital company. That's happening. We think anything that the millennials want and is an area. And remember, Michael, this is the nuance. The millennials are into family formation, but their consumption pattern is so much more digitally focused and experientially focused than the baby boomers, which was stuff, right? And so we think there's going to be subtle nuances. And at the same point in time, we think, defensively speaking, I would suggest, and I was just on calls this morning saying, what's wrong with mega cap tech here for a couple of months just to ride the storm out? There's a time to be aggressive. And the first 6 months of next year is not a time to be aggressive. Once we get clear the views of what the Fed, and they're not going to make a policy mistake, and it just goes back to what we said before, right? Digitization is an important part. And then I also overlay the structural forces of the green economy, carbon credits. I think uranium is going to be classified as sustainable. Lithium. We are going to, rightly or wrongly, go into this green economy. And the way I put it in my mind is the green infrastructure bill is akin to the Marshall Plan after World War II, where that's where fiscal policy goes. So if you do it that way, I think we're going to be okay. But I think people have to understand that there's no way we can raise interest rates right now without destroying the economy. There's no way.
As usual, just great stuff. James Thorne, Chief Market Strategist for Wellington Altus. Jim, thanks so much for taking the time. I look forward to talking to you at the World Outlook Conference, but in the meantime, have a wonderful new year.
You too, guys. Take care. Be safe.
Time now for the shocking stat of the week, but this one will play out throughout the next year. And it's back to you'll be paying more as a theme. And it won't be reflected, by the way, in the inflation stats, but it does add to your cost of living. I'm talking about the big payroll tax increase for both workers and employers. Now, there are three aspects to be aware of, and all of them kick in January 1. First, the maximum amount of earnings that your Canada Pension Plan contributions will be calculated against. They increased 5.3%. The maximum last year that you paid a percentage on was $61,600. This year, 2022, $64,900. That's the biggest percentage increase since 1992. Now, not just that top number, but the percentage of your earnings you're going to be paying. Well, against that new maximum, for example, of $64,900. It also increases, though. You'll be paying more for longer. The rate has now increased to 5.7% of your earnings to that maximum, up from 5.45%. A point, by the way, that's regularly overlooked, that I do not want to do that here. I want to point out that this is a killer for self-employed workers because they pay double. They pay both the employee and employer portions, which means in 2022, they're going to pay 11.4% of their earnings, well, up to that maximum of $64,900. Think about what that means. That means self-employed workers are going to pay an additional $667 to a maximum of $7,000 in CPP contributions. Now, here's a real killer, by the way. If they were allowed to make that mandatory contribution to a private pension plan that earned even anything close to the long-term average of the Toronto Stock Exchange, in other words, I'm not trying to give them a bonus because they're good at stocks and everything. No, just the average. They would literally earn thousands of dollars more monthly, and they retain the sizable principal when they retired. It's the same for workers that are not self-employed, though. If they earn $64,900 up to that, well, you know what? That's an additional $334 in 2022, up to a maximum of $3,500. So this is not small amounts of money. And again, if they were allowed to put that money into a private pension plan, well, their monthly benefits would be much higher, as well as having that lump sum. Now, as for employers, they've got to pay every employee's CPP. They match it. But think about that. The extra cost is especially onerous after surviving the pandemic, if they're fortunate enough to have done that, all the pandemic restrictions. But here we are, the government's just handing them increased costs of employment, along with all the increased costs they're going to suffer because of inflation. Now, according to the latest survey, by the way, by the Confederation of Independent Business, we still only have just over a third of businesses fully recovered to pre-pandemic levels. And now you've got the new Omicron restrictions hurting businesses. And now you throw on the new Canada Pension Plan costs. I can tell you, we don't have to have politics here. We just know it's going to be too much for many. You know, it reminds me of the old Ronald Reagan line, the 9 scariest words in the English language. I'm from the government and I'm here to help. You know what? Actually, they're not. I want to bring in Ozzie Jurek right now to discuss what were the big takeaways for him, because my goodness, what an active year in real estate, whether we're talking commercial, whether we're talking residential, big stuff happened. A topic of conversation, it felt like on a weekly basis. Ozzie, let's start with looking at 2021. I mean, we started right off the year again, we're talking about demand, supply, inflation, deflation, the shocking strength of 2020, and it just seemed to continue.
Yeah, no question. And I remember, like in January, nobody really knew what was going to happen in 2020, and then we had a quarter like no other to close out the year 2020. And so, what would it mean for the year ahead? And one thing I noticed, and we talked about it at length, that there was only 100,000 properties for sale in all of Canada, and it was the lowest number of properties for sale in 30 years. I mean, just 2 years earlier, they had 300,000. So you could almost see that already on January the 1, 2021, there was going to be a problem because all the remaining properties would have more buyers wanting to bid up the prices, and that's exactly what happened.
And it really continued throughout the year. I mean, the lack of supply has to be one of the real red light stories, of real estate, residential real estate this year.
No question about it. And everybody did well. I mean, when you take a look at people in Surrey, just all they did was buy a house, didn't buy it in particularly the best place or made the best deal possible. And then whether they bought in 2019 or 2020, they rose in price at about 35% per year, 2 years in a row. I mean, unbelievable. I mean, if you told that to somebody, they would have said, oh, well, you must be smoking something.
Let me come to something else. CMHC has been in our spotlight for quite a while. It started in really May of 2020 as we got into the pandemic, and they had big warnings about how housing prices were really vulnerable, et cetera. But, there's another side to it. So that's also big. But then they did a study on a home equity tax and didn't tell us about it.
Yeah, and you and I talked about it at length, that we had picked up the idea or heard that it was going to be paid $250,000 to UBC to study the problem. And they said, no, it never happened. No, it didn't happen. We didn't do that in 2019. Then last year, guess what? They found an email from Mr. Siddle, who was then in charge, which very clearly said that that's what he liked, and he wanted to get some of that money that people undeservingly had created. That is, by the way, still on the table. I mean, I still believe that the first step towards eliminating the tax free amount is in the new budget. So right now, if you sell a house within a year, it is already taxable, and it's 100% taxable, not just 50% on capital gain, because you consider to be a terrible profiteer. And so in a way, they bring it in. They say it's only the first. If you do it in the first year, well, what's to say it's going to be in 2 years and 3 years and 5? It's sort of the thin edge of the wedge.
I've always felt it was going to be incremental, whether they would say, I'm going to cap the amount of money that you can make on your primary residence to say $500,000. Above that, you'll be taxed. I thought that was one of the ways they could do it, and then lower that number down. Whereas you've just said, now if you sell a property within the year, you can't claim that primary exemption. But also, as you say, you can't even claim it as a capital gain, which is very puzzling.
Yeah, because well, anyways, the point is, we know, and you have said it many times, that whatever is for sure in the future, whatever may happen or may not happen, taxes are going to increase on things that you didn't even know you owned.
Yeah. Well, as you heard my shocking stat, Canada Pension Plan premiums going up, but a way more than people ever anticipated. So that's just another example, I know. Let's just keep going here for a sec, though. And again, the biggest story that we've been outlining, and I think it's now proven to be correct, is saying the driving force over anything else would be record low mortgage rates. And still, despite all the talk about big rises, et cetera, we've really had a very small, range. If you take like the 5-year fixed mortgage, it really hasn't moved much off the record lows. It's still there.
Yeah, it's gone up. It's over 2%, but in terms of history, it's markedly low. The other thing is that we have absolutely no default rate. We have 0.18 of 1%. We have mortgage default. Despite what CMHC was warning about, we're going to have prices collapse by 18%. People won't be able to afford it. In fact, prices went up by 25%. The other thing that people don't realize, and you and I talked about it at length, is that after you made your payments for 5 years, you probably owe a lot less. So when you renew the mortgage, you will be renewing at a much lower amount, about 15% less. So it is a very safe and very stable investment, and Canadians do make the payments.
Well, of course, as we come into 2022, lots of talk, and we've been doing it today, about potential interest rate increases. And as you say, yes, we've seen some of it reflected in the bond market. We keep a close eye on the 5-year Government of Canada bond because it influences mortgages. But with all of that, boy, have we ever had the continuation of huge warnings about Canada's real estate market. And yet, I know you've talked about this and written about it in OzBuzz. We still have no history of large defaults when it comes to our mortgage market.
None. We are leading the G7 in making the payments. We have 65% of Canadians pay their mortgage, on time, all the time, and almost more than half of that own their properties clear title. But still, I think for this year, we don't really know what's going to happen to interest rates, and there's 1,000 opinions. But if I was in the real estate business to buy an investment, which I am, I like to now time my mortgage up. If I can get a 2.3% 5-year mortgage, I like to sleep at night, and whether that's going to be 1.9% or 1.8% next week, I don't care. 5 years, fix my mortgage. It's still near all-time record lows.
Well, Ozzie, obviously leverage is just such a huge part of the story, as we've been saying. But I mean, you look at across the country, because that's when one of the other features of 2021, part of 2020, was that it's not just Toronto, Vancouver, of course, everybody participated in this. But the record low mortgage rates mean you don't have to put that much down to get in the game.
Well, that's right. And it's also on the leverage that you are making the most money. I mean, in Surrey, you could have bought $1 million house 2 years ago, put down $100,000. It's now worth $1.7 million. The leverage made you $700,000 on your investment. I mean, it's almost unbelievable. It's massive speculation, you could call it. But there's a lot of options buyers have. When you look at 2022, we have people that are in the real estate investment game, not just as a homeowner. Well, if you are, take a good hard look. I wouldn't be buying any vacant land right now, no development property, because you don't know what the municipality is going to do. We don't know what rate's going to do. Don't do that. Buy cash flow. And on the selling side, sell your losers. I mean, there's many times people are supporting their investment. I think this is the time. I'm not saying anything is going to go wrong, but I think we're going to have a strong year. But what if you don't? This is a perfect time to sort of clean up your portfolio and get healthy.
Okay, let's have a quick look at 2022. Jump ahead here. I mean, we saw RE/MAX say you're looking at about 9%. Canadian Real Estate Board, looking at 8-9%. So that's kind of the numbers we're looking at. How about yourself?
Well, I maintain that this inflationary world we're in is going to continue. And, I had a luncheon with two fellows that also owned a fish and chips shop 50 years ago, like I did in White Rock. And we sat down and we said, you know what, was it really only 10 cents for an ice cream cone? Was it really only 10 cents for a chocolate bar? And I said, I used to buy a box of 24 chocolate bars, cost me $1.90. I had to sell all 24 bars to make 50 cents. It's almost unbelievable. Today, that ice cream cone is $9. That chocolate bar is $5. And that's inflation. And we have had this inflation massively in the real estate world with leverage. So the average investor has done beyond their dreams. And it's going to continue as long as you point out we have those low interest rates. The money is available. It's going to continue. No question about it.
By the way, I'm smiling because that's the absolute sign of being an old man. I drive around. I drive around with my kids and I go, I used to go to a movie for 25 cents, and so I'm only smiling because they make fun of me and you just did it. Yeah.
Yeah, I did it. But the point is that is inflation, massive, absolute massive inflation. Okay. So, but in these dangerous times, you have half the forecasters are saying it's going to be a terrible time. So go get safe. I think I would want to be pre-approved on all my mortgages. If I buy a real estate for investment, buy it near transport. People are more and more transport oriented, like SkyTrain and so on. Have some, if you're into the pre-sale business, read the contract, to understand the assignment clause. And there's many things that you can do in this market to still be safe, but still make a good investment.
Well, one of the things they can do is go to ozbuzz.ca, and we'll be here to chronicle it. Ozzie, you and your family have a wonderful new year and look forward to chatting soon.
Well, and I wish everybody an exciting, an eventful, a challenging, and above all, healthy 2022.
Let me go to my cleanup hitter. I've got Victor Adair ready to go live from the trading desk. Probably after Victor enjoying a couple of quieter days. At least Christmas gets quiet for you, but now you're ramping right back up. Let's talk about 2021. Obviously, that's what we've been doing in a year in review here. But I've always find it interesting. What's jumped out at you when you think back on 2021?
I think the tremendous rise we had in stock markets. There was a flow of capital around the world into stock markets like we've never seen before. You know, people were seeing stock markets going up, and I think it was a case of, I've got to get in. We had over $1 trillion of new capital flow into global stock markets. That is something like, it's greater than what we've seen in the past 19 years put together, to give you some perspective as to how much people rushed into the stock market.
I mean, that's an incredible statistic. I want to just stop at that for a second. I mean, obviously money coming in is the fuel that makes that engine go. And to say that we've just put in more than 19 years combined, it's sort of like, I've got no other questions about why the market went up to some degree, especially so much of that money pouring into, I mean, one of our themes has been, it's poured into these few stocks that has sort of given the illusion of a much stronger, stock market than maybe is there. People might be looking at their own stocks and going, wait a second, I'm down 50%. 67% of the NASDAQ stocks are off 50%. But those big ones, the ones you've been talking about and warning us about for quite a few months, that's where the action is. But my gosh, no wonder they got goosed. $1 trillion, really in 1 year.
There has been that tremendous flow of capital coming into the markets that's done that. I mean, the NASDAQ is up about 30% year to date. The Dow's up 20%. Toronto indexed up about 25%. Another thing I've noticed, Mike, has been like the volatility has been great. We've had a lot of new investors, for instance, going into the options market where they can get great or tremendous leverage when they get an idea. We've had a new expression called YOLO, Y-O-L-O. You only live once. That's an investment psychology. I think we're seeing all kinds of signs this year that the risk-on attitude in investor psychology is getting increasingly speculative. People are reaching deeper, for yield or for excitement. I think the volatility and the attitude that you can't lose, and what the hell if you do lose, you only live once anyway. So, roll the dice, big guy.
Yeah, and when we remember back to January, we had the so-called Robinhood, the meme stocks, all of that stuff. AMC, was one of the big ones. There's so many. BlackBerry was another, but that was a new era when stocks didn't seem to care about valuations. It was just the amount of people flowing in with money.
Yeah, the what we would call the value stocks just got left in the dust. I mean, everybody was chasing momentum. That you were mentioning the concentration in the big cap tech stocks. Well, it wasn't just in relative to the rest of the market. The American stock indices, which were powered ahead by these big cap tech stocks, absolutely smoked the rest of the world. Now, we look at something like the emerging market index. It was down, I'm guessing here, but it was something in the neighborhood of 20% from its highs this year. And yet you got to blame China for that, because China's a big part of the emerging markets. But it comes all the way back to a handful of big tech stocks in the United States, goosed the American market, pulled capital into markets all around the world like basically never before. And at the same time, people were willing to roll the dice on very speculative plays.
And I think that's, excuse me, Vic, I don't want to put words in your mouth, but the takeaway has to be coming into 2022, that volatility, the volatility of 221 is going to be with us, and people have to be aware on that. They have to be really cognizant of the old what goes up does come down, parabolically many, many times. I mean, I'm still surprised by, big names like in Canada, you had Tilray, down about 90% from its high. And I remember getting phone calls, as you do, Dick, getting a phone call, should I jump on board Tilray? Should I jump on BlackBerry? Should I jump on, Beyond Meat, which is down 70%? I literally got calls, and the stock would be up like 50%. Well, I have no idea, because it's not based on the fundamentals. But you look at that kind of decline from their 52-week high. I just hope people walk away understanding that there are two sides to this coin. And I'm not trying to be doom and gloom. I'm just being realistic. As you and I have both said, you get something rising parabolically. Usually the decline is equally abrupt and intense.
Yeah, we've had all these signs of what I would call froth, with the speculators chasing things. But the underlying background was, I think, one of the key items when it actually happened in the previous year was the vaccine. I mean, the vaccine happened, and it just seemed to change, the likelihood of some kind of existential risk from the COVID vaccines, from the COVID the virus. We also had a major change in the White House. Joe Biden came in. It seemed to be much more willing to work with other people in the world than Donald Trump. The Federal Reserve continued their massive stimulus throughout the year. Listening to Michael Levy earlier pointing out, the transitory thing. But the fact was that the Fed just continued to push money into the system. And that coupled with, I think, politics, the Fed and the change in the worry about the COVID kind of gave us support, psychological support to people to run into the market the way they did. And certainly, by the way, just as a sidebar, they ran into what we would call ESG investments in a huge way as well. And another aspect of ESG, of course, is a lot of the institutional accounts decided they wanted to have nothing to do, with dirty oil and that sort of thing. So there was this turmoil in the markets. As we talked a few times over the year, the markets were not monolithic. You'd have part of the market doing really well, another part, like Tilray, you're saying, doing really badly. Going into next year, my guess would be, in a word, we're going to have more volatility because of where we are now.
I don't want to leave this. I want to come back to what you can see as maybe the biggest worry you have coming into 2022. But before I leave, the energy story, I think, is one of the big stories of the year. And I'm thinking in terms of looking what energy prices did in Europe. The natural gas price, the price of coal. You look what it's done in China. The list is a long one. Diesel, I can go. Uranium did well too. These energy plays went way up. And because we do not have an alternative renewable grid before we stop investing in oil and gas production, I think that was a foreshadowing of what's to come. I want to be clear. I think there's been a huge mistake to let people who do not have the sophistication run energy. The ramification. You can say, well, Mike, that's your opinion. I bet I can go talk to everybody in the UK right now and say, how do you feel about 15-year high in electricity prices? How do you feel about natural gas prices up 625%? How do you feel about, the list just keeps going on because they had a policy that did not recognize that you need alternative grid ready to go. And secondly, if you do use solar and wind, this is what's happened in Germany, what's happened in the UK, you need backup power. You need some, and they took it out. So I'm just saying, I think that story wasn't just a huge one, obviously, for 2021. I think that was one that we're going to revisit, not necessarily in a straight line, but we're going to revisit that.
I definitely agree, Mike. I mean, energy was the dog of the market in 2020. We had negative prices. Remember that in April of 2020. And then it became the star of 2021. A quick takeaway. I think there's probably been a hell of a lot of money that was invested really poorly in the energy space in 2021, and that'll probably continue as we go into next year. And part of that, I think, also came from the shunning of fossil fuels, and like somehow, on a wing and a prayer, we're going to be fine with the renewable, sustainable program, the ESG program. That's just like you, that's my guess. But when we've got energy prices here at the end of the year and natural gas prices in Asia and in Europe 10 times the level of what natural gas prices are in North America. You just think this thing is getting wound up so tight, something's going to come apart here.
And we'll be chronicling it. But Vic, before I let you go, I want to come back to something you just sort of alluded to last week. But, I just want to know, just in a nutshell, what's your big worry when you look at 222?
Oh, I guess my big worry would be the markets will be dull and boring. I tell you what, there's a couple of the firms that I follow, the big Wall Street firms, and they do intensive surveys of different fund managers they have as clients. I've seen two of those, and the average or the typical biggest worry is that the Federal Reserve, which now seems to be on a path to be tightening policy, may be making a mistake, that the economy may be at risk here of softening, whether it's from energy or, more COVID, or just the economy got goosed and it's going to soften, whatever, going into next year. That's what's on the mind of the fund managers, is the Fed is making a policy error. I have to tell you that our longtime friend, Bob Hoy, sent me a note saying, no, they're wrong about that. The biggest worry that they should have is that speculators who've been really goosing the market in 2021 are going to become exhausted. And that's what you want to worry about.
Well, we'll be here, as I say, to chronicle that, Vic. In the meantime, you'll be with me at the World Outlook Conference. I still encourage people. There's just so much going on. I feel, and I know you said this to me earlier when I said, let's do a year in review show. You said, there's no way you can't be anything but superficial because there's 722 things you've got to keep in mind. But they are driving a market. 2022 looks to be different, as you just alluded to as an example. What is the Fed going to do? What is, the impact of the Omicron virus, over the next several months, or the restrictions, I should say? We don't know how that ends up. There's just so much. And that's why, I'm kind of happy we get to the first week of February when we get to discuss these things and review these things. And I really encourage people to do that, is to join us at the World Outlook Conference. Victor will be there, mikesmoneytalks.ca. And by the way, what a great call we made, Vic, to go online again. We had that big debate going back a few months ago, whether we should be live or whether, go back to the previous format or go online. And I think we all correctly called, you just wait. There'll be more restrictions coming by the time we roll around with that. So it's online, which is great for everyone. And I look forward to having you there, Vic, and many chats before then.
Well, thank you, Mike. I look forward to the World Outlook Conference as well. I've been attending them, I guess, for the better part of 30 years. So yeah, it's a fun thing to do. Well, I look forward to it, and Happy New Year to you and to all our listeners.
All the best to you and Gina.
Thank you.
Time now for the last goofy of the year, and it's a much bigger story. It's about China, but in this case, it's specifically in early November, tennis star Peng Shuai said on social media that a former Chinese vice premier sexually assaulted her, raped her in 2017. Well, immediately she disappeared, and her social media presence, along with her accusations, were erased. Now, weeks later, she surfaced in a carefully choreographed photo shoot, and then she did an interview with the head of the International Olympic Committee, who acted as little more than a mouthpiece for the Communist Party of China. Now, here we have, in the last week, right on script, Peng Shuai told a Singaporean newspaper that her allegations of sexual abuse had been misinterpreted. Really, that is part of the Chinese Party playbook. But by the way, to their everlasting credit, the Women's Tennis Association still reiterated its call for a full, fair, transparent investigation without censorship into her allegation of sexual assault. Not sure where that would lead, because the Chinese Communist playbook is very straightforward. Your choice is to comply or disappear forever. Remember Dr. Weng Liang? He's the Chinese doctor who was hailed as a hero because he raised the alarm about the coronavirus, in late December 2019, but then was taken into custody and forced to retract his statement. Intimidation, coercion, forced confinement, and threats are the norm for the communist regime of Xi Jinping, which not only Canadian hostages Michael Spavor and Michael Kovrig can attest to, but so can so many other Canadians, as CSIS has outlined. In Canada, They've been threatened. But more importantly, their family and friends still back in China have been threatened. I mean, it's a pattern that's been repeated on numerous occasions and so successful that the Canadian government dares not do anything that may offend the communist government. Several times, the Chinese ambassador has threatened Canada if we say anything to upset the Communist Party. They threatened Australia too. The only difference is that Australia has principles they think are worth standing up for. But instead, in Canada, we've ignored rape of the Uyghur concentration camps, the input of slave labor on billions of goods coming from China, the break of a long-standing international agreement in the takeover of Hong Kong and the subsequent suspension of basic freedoms, the threats against Taiwan. We've ignored them. The list, by the way, is much bigger. There was clear interference in the recent federal election. We got politicians in Canada on the receiving end of communist money. We got infiltration of our boardrooms and academia. As Canadian Security Intelligence Services Director David Vigneault says, China is, in quotes, using all elements of state power to carry out activities that are a direct threat to our national security and sovereignty. You know, only the most delusional think this aggression is going to end. Because Xi Jinping himself told us the goal: domination technologically, economically, politically, and militarily. You know, for the last 6 years, as Terry Glavin says in quotes, Canada's been more than just a weak partner to the West. Canada's been an active agent in the Communist Party's long-term plans, which has been quite open about talking about taking over the world, dominating the world. So here we go. Is 2022 the year we get a backbone and take the Australian cue on China and show some principles that are worth standing up for? That's all the time we have. Hey, by the way, I'm really looking forward to sharing more of Money Talks as we go into 2022 and, of course, the World Outlook Conference. And I can't encourage you enough to make sure you're part of the online presence. By the way, that was our first good call, as I said. We said we're going to have more restrictions. We've decided this going back months. We're going to have more restrictions, so it's going to be online again. Great opportunity, though. Go to mikesmoneytalks.ca. And if you want to get a much fuller picture of what's going on, go to Money Talks tweets or Michael Campbell's Money Talks on Facebook. I can tell you every single week we post dozens of stories, facts, quotes that you're not seeing anywhere in the mainstream media. In the meantime, I hope you have a wonderful new year and all my best in 2022.
This is the Money Talks podcast with Michael Campbell, available at mikesmoneytalks.ca or through your favorite podcast subscription service. Join us on Facebook at Michael Campbell's Money Talks and on Twitter at Money Talks Tweet.